Is there any reason to buy gold, especially in this economy? We're going to go through what would be a reason to buy gold in any environment, and then take a look at the current environment and then see what might have to happen to see another bull run in gold, because it's been a tough go of it for the precious metals commodity space at large. Gold and silver both seeing a ton of downside. But gold, and you might not have really noticed this amid all the action in stocks and bonds and US dollar and everything else, gold has pretty quickly fallen from trading between 1900 and 2000 for the bulk of 2023. It slipped far and pretty quickly, and now nearing 1800. And has a lot of people wondering, if the US dollar strength continues, if the US interest rate strength continues, can there be even more pressure be put on gold to the tune of 1700, 1600, these further downside prices? And we'll take a look at a broader lens of gold's price history in just a second. But I do want to illuminate what the reason would be for buying gold and why US dollars and interest rates are putting pressure on this market. Because you might think, well, Frank, gold, bonds, dollars, options, flights to quality, right? VIX moves higher, gold prices move higher, bonds move higher, everything moves in tandem when it comes to these flights to quality. Well, yes, they can be positively correlated and they can share a lot of similarities. One being that they're, fear measures of sorts, or people tend to flock to them when fear is escalating. They actually have a lot of differences. And right off the bat here, starting with gold, yes, it's considered a store of value. Yes, it's considered a quality asset that people flee to when the economy is slowing, or people are worried that the economy is going to completely change. But keep in mind that it's a non-interest bearing asset. And so the recent fear and slowing of the global economy that we've seen has been, by a large degree, a function of higher interest rates. And so when you have a non-interest bearing asset and you have interest rates rising, that non-interest bearing asset, even if the economy is somewhat fearful, it's not very attractive. We'll go deeper on that in just a second. Then in bonds, you have an interest-bearing flight to quality that has a U.S. bias, right? Maybe if there is some fear that is rooted in the U.S., there might not be so much of a demand for that flight to quality versus German bonds, versus Japanese debt, and what have you. And then you also have US dollars and Japanese yen, two currency markets that historically have been seeing flight to quality type movement, especially recently. That US dollar, amid the pandemic fears and then the inflationary fears of the last year or so, and then now, as well as interest rates rise and the global economy is slowing down a little bit, this US dollar has been a pretty powerful flight to quality that has obviously a heavy bias to US interest rates and the US economy. And so essentially, if there's fear globally, but the US is relatively doing well, some people will flee to that US dollar. Similar with yen, and this has been more of a historical case of flight to quality, especially throughout the 80s, 90s, and 2000s. You'll see that Japanese yen rally, people flee to it in times of global fear, but that it has been somewhat reduced recently, given that Japanese rates have been some of the lowest of major economies, and it's been one of the slowest major economies across the globe. And so not so much that yen flight to quality recently. And then, of course, options. It might not be in a textbook, but of course the VIX, when does it rise? When stocks are moving lower, when there's fear. It is quoted as a fear gauge. And so I threw in options in there as obviously a stock insurance, but that has a time component to it. It has a bias around that as well. You can't necessarily just say, hey, I see fear brewing. I'm going to buy S&P 500 options. There are a lot of different biases in there, similar to a gold or a dollar or a yen, that can kind of work against it. None of these are flights to quality that are one for one with fear. They all have their own nuances, and hopefully you can understand that. And now let's move to what's the most important, obviously, which is the price action. What actually happens? And you can see over the course of the last couple of years here, high interest rates have really hurt gold prices. Now, gold is still, relatively speaking, mid-range to higher end of its range, above $1,800. It's been as low as the 1,600 handle in recent years. But take a look at the red line there, 10-year interest rates, and the black line there, gold, and you can see that sometimes they move in the same direction, but when one is seeing an extreme level, the other is usually moving in the other direction. When gold put in that high in early 2022, interest rates were moving lower a little bit there. And then when interest rates were seeing their high in the later part of 2022, gold was seeing its low for the last couple of years. And now, especially recently, as interest rates make new highs over the course of the last couple of weeks, gold has been backing off to the tune of, $100 worth of losses in the last couple of trading days. And you can see here, given historical prices, there's still a fair amount of ground to cover if gold does want to give up some of the last couple of years of rally, especially right around the pandemic. Gold moved from this trading range of $1,000 to $1,500 and escalated into the $1,500 to $2,000 trading range. So it'll be interesting to see, one, what low holds. Is it 1,800, or is it the recent low of about 1,500 to 1,600, or do they go back to the 2010s type of trading range here if interest rates continue to climb and this gold asset, non-interest bearing asset, continues to get less and less attractive? It'll be really interesting to see, because you take a look at the historical view for interest rates as well. There's more upside if this market wants to get back to the 1990s or aughts, trading in the 5 to 6 and even up to 8% range, and you would imagine that getting back to those levels could send gold down to where it was trading in the aughts or the 2010s. Maybe we don't see triple digit gold again anytime soon, but still a fair amount of ground to cover to the downside if interest rates hold in or even ascend. That non-interest bearing asset might get less and less attractive. So on weeks like this one, maybe not a lot of reasons to be buying gold, but of course, our economy is ever changing, and what could amass to a gold rally similar to what we saw in of course it goes without saying, no one wants to see another pandemic outbreak, but what we did see in terms of asset price action at the outset of the COVID pandemic in early 2020 was stock downside, interest rate downside, gold rally. And that's been the recipe over the course of the last couple of years. And that makes sense, right? Because if interest rates are moving lower, that gold market being non-interest bearing means less. And then also, if stocks are moving lower, that fear is escalating. And so you have the double whammy of interest rates not being as relevant, stocks moving lower and fear building, and that flight to quality in gold becoming more attractive. That's not where we're at right now. Stocks are moving lower by a little bit, but it would take more than this, you would think, to move that interest rate market lower as well. So not a whole lot of reasons to be buying gold at the moment, but of course, these different circumstances and market environments can change on a dime.